Alright guys, right now let's talk about moving average. Now basically, since I've went through moving averages in my beginner's course, I'm not going to go into the super basic principles. Now the principles of MA is that the steeper the slope, the stronger the trend. And when it's sloping up, it indicates a bullish market, and when it's sloping down, then it is indicating a bearish market. So basically, what are the functions of moving averages? The first one is that it used to identify an existing trend. So moving average is a trend indicator, okay? And it helps you smooth out the price action, because if you look at the calculation, this is what it does. And it helps you spot emerging trends or trend reversals, and it helps you generate trading signals, okay? Especially when the price retraces back to the moving average. And make sure you don't use moving average to forecast or predict the price, because no indicator in this world will allow you to predict the price movement. So a lot of people would ask, is SMA better or EMA better? Now let's compare both of them. Now SMA, if you look at the way it is calculated, the calculation is consistent, and it is more suitable for longer term traders, and it has a slower response to changes in price action. But the thing is, the good thing about slow response is that it will give you less false signals. But with EMA, the drawing may differ from one platform to the next. When you're using different brokers and different platforms, you might realize that the EMA is a little bit different, but most of the brokers, they'll try to stay with the same consistent calculation, and hence the EMA drawing, okay? And it's more suitable for short-term traders. So you find that a lot of short-term traders, they tend to look at EMA, they tend to use EMA a lot, and EMA gives you a faster response. That is why it is used for shorter-term trading. But the thing is, faster response also means that there will be more false signals. So there's no saying that, okay, is EMA better or SMA is better. It depends on the time frame that you're using it on, okay? It depends on how long you're holding the trade. But I prefer to use both. You don't have to really pick one. Now there's no saying that EMA is better unless you're trading futures, because most future traders, they tend to use EMA more often, and hence if you're a futures trader, you might want to focus more on EMAs. But on stocks and also on currencies, it's fine to use both together. And just bear in mind that SMA, if you use smaller numbers, it's going to give you faster response, because the higher the number, then the slower the response of. And also, smaller numbers tend to be suitable for short-term trading. For example, 1 to 20, 20 to 60, it would be MAs used for medium-term trading, and above 60 would be for long-term trading or even investing long-term. But for me, I tend to use all of them in combination, because a lot of people ask which MA to use. Like I said, I use a combination of EMA and SMA, and also short-term and long-term moving averages. So you can see that there are a couple of lines over here. The blue line, okay, that sticks closely to the price action is 5 EMA, and we normally use 5 EMA for breakout trades. And if there's nothing to do with any breakout trades, I'll just remove it, because it kind of blocks the candlestick a little bit. So sometimes I'll tend to remove it, and when I need to use it, I'll put it back, okay? And 20 SMA, which is this dotted line over here, alright, and 50 SMA, which is this yellow line over here, 100 SMA, which is this white line, 200 SMA, which is this blue line. Now I've covered 5 EMA, 20 SMA and 100 SMA in my beginner's course in very detail, so in this course I'm not going to go into super detail about these three indicators, but I'm just going to give you a quick recap, okay? So 5 EMA recap. Now the settings, I'm sure you know already. Period is 5, shift is 0, apply to close, MA method, exponential, okay? And basically a 5 EMA is used to trade breakouts. So for example, how do you know whether price has broken this support line over here? How do you know whether is this candle considered a break or is this candle considered a confirmed break? How do you determine? You gotta zoom in and see whether the 5 EMA is it above or below the support. So you can see even though this whole entire big bearish candle is below support line, it seems like it has broken support line, but actually it is still above because your 5 EMA is still above the support line. Whereas the real breakout candle would be this candlestick. Why is that? Because the 5 EMA of this candlestick is right here, which is below the support line. So a confirmed candle that has broken support is this green candle. Alright? And the DSMA I've also covered in a previous course in detail. So right now I'm just going to give you a quick recap. So basically, the way I use the DSMA is to increase my probability of my trades and also to prevent myself from getting into a trade. For example, if I have a buy trade here, I wouldn't enter because every single day, okay, so one column here is 1 day. Every single day, you realize that price has to touch 20 SMA at least once, right? You see, touch here, touch here, touch here, touch here, 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 and here. Okay, every day it has to touch. Of course, once in a blue moon, it wouldn't touch for a whole day, or maybe as long as 2 days, but most of the time, 95% of the time, it will have to touch the DSMA. So if I have a buy trade here, I would be more careful to prevent myself from getting in, because if I enter here, knowing that 20 SMA is below, if my stop loss is right here, I need to be careful because from this point onwards, price hasn't touched 20 SMA yet. So I know price has to come down to touch 20 SMA, and you can see what happened. Price came down and touched 20 SMA before going up. So if I have a buy trade here, I wouldn't enter. Understand what I'm saying? Similarly, if I have a buy trade here, I wouldn't enter because from here, which is the start of the day, until here, price hasn't touched 20 SMA yet. So if it has to touch, where does it have to go? It has to go down. You see? Price came down here from the top. So if I have a buy trade here, even though like all my other indicators tell me to buy, I wouldn't buy because of this 20 SMA. It is a very powerful indicator, okay? But if it has touched already, then you don't really need to care about 20 SMA. You can remove it for the day, okay? And you want to get into a buy trade when there's a signal from either a moving average or a support, okay? Now 50 SMA, this is an intermediate moving average. And you'll find that very often times, price would test 50 SMA and then bounce up, test 50 SMA and then bounce up. And this is a pretty common occurrence. And the next SMA is 100 SMA, which price would test less often as compared to 50 SMA. But if it does break 50 SMA, it will come down and test your 100 SMA. You'll see later on when I combine all the indicators together. But 100 SMA is a long-term moving average, and normally 100 SMA is used to spot crossovers rather than finding a place where the price would bounce off. And also, just take note of the distance of the price from the 100 SMA. If it gets too far away from the 100 SMA, it is like a rubber band where it has to snap back to the 100 SMA. So if you have a buy trade somewhere up here, be careful when it is too far away from 100 SMA and you have a buy trade or sell trade, okay? Be careful of the distance of it from the moving average. Now for 200 SMA, this is a longer term moving average, and you realize that price very seldom would it come down and touch 200 SMA or come up and touch 200 SMA. It has to break 50 first and then followed by breaking 100, then it will go and touch 200 SMA. But why do we use this is because you'll find that even some of the news channels, they tend to use this. A lot of people are using this, so we need to know what the dumb money and smart money are looking at. Now 200 SMA is a good moving average that you can use for many different currency pairs. Also can be used in stock investing, stock trading. For a sell trade, you want 200 SMA to be sloping down, price to be below 200 SMA, and when it comes to an uptrend, you want it to be sloping up, and then you want the price to be above 200 SMA for you to get into a buy trade. Okay, let me give you one example. If I put everything else together, how do you find a strong bullish trend? Basically, a strong bullish trend is defined as price being above your 50 SMA, 100 SMA, and 200 SMA. And then your 50 has to be above 100, 100 has to be above 200. And you can see that along the way, price will come down and test 50 SMA. Sometimes price will come down and test 100 SMA and bounce off. And then come down to 100 SMA, bounce off, 100 SMA, bounce off, 50 SMA and bounce off, 50 SMA and bounce off. You see, seldom it will come down and touch 200 SMA. Okay? So when you're learning to spot a trend, the main indicators are 50, 100, and 200. And all these three indicators has to be sloping up, ideally. And when it comes to a strong bearish trend, it's defined as 50 being below 100, 100 being below 200. And the price has to be ideally below 50. Right? And you can see in this case, price tested 50 over here, over here, over here, over here, over here. In fact, didn't really test 100, only until way at the end. So the thing is, in a bearish trend, you want the three indicators to be sloping downwards. If you start to see a crossover or a change in slope, then be prepared to get up. I'm going to talk more about moving averages in the next part, the second part about moving averages. So with that, I'll talk to you in the next lesson. Bye.